Hi, I'm Richard Osborne from UK Business Forums, and welcome to our first ever webinar. And today we're talking about finance, raising finance, access to finance for your startup and small businesses. With me today, I have Mark Jones from Fit Out Finance.
Good morning.
Mark is our resident expert on UK Business Forums, available online, answering quite a number of questions about when people come online and they ask about loans.
Yes.
Yeah. And so really what we're going to be running through today is talking about the different types of finance that there is available, and how you access that finance, and to give you the best chance of successfully applying for funding in whichever way, shape or form that takes. And so thank you again for joining us, Mark.
Our pleasure.
There's quite well, when people think about finance, I feel it's quite glamorized on TV, particularly with shows like Dragon's Den, where you'll get a lot of entrepreneurs who will go onto the show with very focused on their product, particularly, and with and they'll pitch to multi-millionaires sat in a room, and somebody's going to give them a lot of money because that seems like what it is, but that's not really the right picture, would you say?
No, it's glamorous is the word you used. It's television.
Yeah.
There are good business messages in Dragon's Den, but as you highlight, it's not really about the product. I think my recurring theme today will be a plan and a purpose.
Yeah.
And if we can keep coming back to that, that's really the nitty-gritty, the nuts and bolts of applying for finance.
So I've mentioned there Dragon's Den, so investors, but how many different types of finance? So if we put everything under an umbrella of finance, how many different types of way are there for small businesses to access money, cash?
Well, yes. I mean, every business needs finance in some shape or form, whether it's the cost of a bucket and sponge or £1 million to develop a product. And I use that. I encompass your own resources as well, the money you put into the business. The business itself is still receiving finance. I'm going to refer to my list here, actually.
Yeah, go. Yeah.
In terms of types of finance, what we have here is obviously your own personal money. Now, that might not be your own money. That might be money you personally go out and borrow on a credit card, by remortgaging your house, taking out personal loans or whatever. You've already mentioned investors and angels, who can be great for some of the bigger, longer-term projects and various other things. There are variously grants available, difficult topic grants, because they tend to be regional, specific, and very, very fluid in their availability. Business loans, secured or unsecured business loans. So either you have the money with a personal guarantee, or you put some proper security up behind it. Overdraft and spot funding, if you need money just occasionally, just to dip into, 4 days a month, 1 month a year, they tend to be quite useful. If you're in a B2B environment, selling products mostly to other businesses, you can use what's called trade or invoice finance. So you effectively raise money against a contract or against an outstanding invoice. And then, of course, asset finance, which is my big area of speciality. If you're buying pieces of equipment, you borrow money against that equipment.
Okay.
So that's really the types of finance in a nutshell.
Yeah. So if we run through each of those, just to paint a picture of what that actually means. So you started off talking about pardon me, your sort of personal finance or individual. Now that's something, like, if I refer to myself, I'm familiar with in that one. So I started one of my own businesses on 3 credit cards and a home improvement loan. This is where, through your own personal liability, I suppose, if I use the word, you go out and get that money. You might have some savings, I guess, but what's the, I suppose, risks in that, and who would be the sources of that? We run through the different options. I've heard like the triple F, FFF kind of like scenarios as well, but how would you source your personal finance, and what's the risks?
The biggest risk in taking finance, once you've got it in your pocket, it becomes very expensive if you can't make your repayments on time. You touched on credit cards. Used well, they can be a fantastic source of financing your business, particularly if you manage to play your interest-free periods. And I know people have built very good businesses on the back of interest-free credit cards. If you've been over-optimistic on your projections and you find you're unable to make your payments, then you run into problems. So, specifically with credit cards, you say you have to have good cash flow to manage that. It can't be a wing and a prayer. Obviously, at the other extreme, if you remortgage your property, your partner might not agree with you. It's a fairly heavy-handed way of going about things, but if you need, a larger sum of money, it will give you a far longer time to pay it back, and you're less likely to run into that problem of not being able to meet repayments as they fall due. But as they will clearly tell you, your home is at risk if you don't keep up payments on it.
Is there's a perception that using like your mortgage to remortgage, it's the cheapest source of personal funds. Is there any truth in that statement?
Cheap's an interesting concept, isn't it?
Yeah.
If you look at APRs, your mortgage is likely to be the least expensive APR.
Yeah.
The cost of taking out a mortgage is substantial, particularly if you're only after a few £1,000s, because you've got your legal fees, your valuation fees, various other fees. Whereas a credit card you can apply for and have the card in your hands in 2 days' time. So I think comparing costs is so circumstantial. You can't really compare cost without a lot of analysis of the needs, the circumstances.
Okay. What about borrowing from friends and family?
Family are always going to be your most benevolent lending source. They're unlikely to punish you too much if you're late in repaying them. I would suggest the risk factor in borrowing from friends and family is reputational. And I say, if you have a solid plan, if you're going to repay them, then I would thoroughly recommend using friends and family. But you can get fallouts, of course, if things start to go wrong.
Yeah, that to me, it's not borrowing from friends and family isn't something I've done myself, and it's the fear of, if I liken it to starting my own business, I'm taking on that risk. I'm going into it aware that it could fail, and in fact, statistically, more businesses fail than succeed. So we know if you're borrowing money from friends and family, you are more likely to let them down than you are to be able to pay them back, if you look at it, in my view, that way. So I'd raise a red flag at that one as friends, family, because it purely from the reputational aspect you mentioned.
What I would throw in, everyone has different personal circumstances and different relationships with their friends and families. The one thing I would throw in there is, if you're going to use friends and family, make it a business transaction. Put terms on it, put conditions on it, and meet those terms and conditions. Don't, this also applies to using your own money. Don't put it in your money into your business as a gift. It's a business transaction. Your business is taking out funding, even if that funding comes from your own pocket, your redundancy money, your parents, your inheritance. From a business perspective, that is a financial transaction that has to be accounted for.
Very, very wise advice in that one. Keep it professional. The other one you mentioned, and Business Data Group, so the company behind UK Business Forums, my business, has 2 angel investors in it. I've been through this journey myself. Interesting journey. I learned a lot from that experience.
Yeah.
We can come through to some stories and maybe some scenarios later on, maybe rarer, but talk us through what an investor or an angel source of funding is.
Okay, so I'll put them, I know there are some differences, but to put them under one banner, they put money into your business and they want something in return. By and large, what they want in return, to varying degrees, is an exit, a big payout on exit. They will probably want some dividends. They might well want consultancy fees as you go along. But what they also want is input and insight into the business. So angels and investors, you are entering into a relationship, not a financial transaction, or not just a financial transaction. That relationship will vary. Some of them will want to be hanging around your offices, having an input in how things are done. Some will want to see management figures monthly, but all of them will want to know how things are going, and they will want a degree of involvement in the running of the business. And that involvement, of course, can have a very positive angle because they will be successful business people. They will have connections, they'll have experience, they'll have contacts. They can bring a lot of value. But as the investee, as I'm sure you've found, you have to embrace them and the value they bring, rather than seeing them as an intrusion into your business.
From my personal experience, in the early days, they would always talk about your business, Richard. Okay, how's it going on in your business? And it was important to me to, as much for my mindset as theirs, to adopt the our business stance, because the transition I had to go through was I may have founded and started this company, but it's not mine anymore. It's ours, and it's the company, the business. And I think that's important for people looking at, it's always the advice I give is when people are looking at bringing in investors, right, before you go any further, get it out of your head that it's your company, because you are giving a share of your business, or not giving it away, you're getting investment.
Yes.
But as part of that relationship, you are now going to have other people that are going to own part of the business. And exactly as you say, they're going to want to know everything about the business that you know. They're going to want to know the financial performance, good and bad. They're going to want to know the business plan, objectives, how things are going on day to day. It's part and parcel now. It's been a few years. I'm used to it.
Yes.
But writing up regular, detailed management executive summary reports, and producing full KPI statistics, financial summaries, cash flow forecasts, and giving all that information for their oversight. Your comments about their impact as well is positive. They're right. These are successful business people. But it's a investment. It's a transaction for them. They're not doing it because I've got a few spare hundreds, thousands laying around. Just let's punt it on the horses.
Absolutely.
Yeah.
And as you know, they'll have a lot of people wanting money off them and wanting experience off them. So you do have to put yourself in a position where they are genuinely interested in you and your proposition.
Yeah.
And to come back to the proposition, it is about the business and the way you run that business, more so than just your business idea.
Yeah. And it's not just the product. You mentioned that earlier. It is the business. And
it is.
Is it an investable business that will make a profitable return? Yeah. Grants, you said that's quite a interesting one.
Fluid, I think, is the word I'd use. I certainly can't give much specifics on it.
Yeah.
But a grant has a purpose. To be fair, everyone who puts money into your business wants something back. When it's your parents, they just might want you to be happy and successful. It might be that esoteric. Anyone who does it commercially has a agenda and an objective. Grants always have an agenda and an objective. So it might be development of certain technologies. It might be to do with employment in an area, or occupying new brownfield spaces, or developing tourism in an area. But a lot of those things are regional and specific to an area.
So there are particular rules attached to them that you have to meet this relevant criteria,
yes, and
before you're eligible for it.
They will come with criteria, and they will come with a lot of bureaucracy.
Reporting afterwards.
Absolutely. Friends of mine got a grant to add letting accommodation to their pub. Yeah. They had to pay out the full amount of money and seek a 50% reimbursement. They had to provide a lot of information for it. So whilst it was worthwhile to do it, you had to have a very evolved project for it to make sense and for it to work. Yeah. They didn't just put a pot of money there and say, go and build some rooms.
There's a perception that it's free money, in the sense that the government gives you this money and you don't have to pay it back, and you don't have to give up equity in your business. Is that true?
Somewhat, yes. Yeah. I mean, once your grant is in place, by and large, yeah, you have the money. The process of getting it, time is money. Yeah. All of these things take time and effort to put in place, some more than others. It might well be that the time and effort you put into getting your grant would have been better spent elsewhere in the business. But yes, but as I say, the availability of grants is very, very variable.
And it has a lot of criteria that matches that. So you could have two businesses next door to each other. One business might be eligible, the other one might not be.
Absolutely. Yeah. and grant comes in pots. So if they've emptied the pot, you won't get a grant.
Okay. Now, you mentioned loans, and then you also separated them out as like secured and unsecured. Now, I'd imagine pretty much anybody watching this is familiar with what a loan is. You can go and get a loan to buy a car and so on, but we're talking about business loan here, not personal, we mentioned earlier. So where does sort of secured and unsecured and loans come in? And I probably suspect it's worth mentioning personal guarantees as well.
I think we must mention personal guarantees.
Yeah.
Let me start with the government sponsored business startup loan. Yeah. Because in my view, that is a fantastic product for any startup. It is the only loan you will ever get that is underwritten on the back of a business plan alone. Everyone else will want to see a little bit more in terms of personal security. So the government startup loan scheme is incredibly flexible, £500 to theoretically 100,000 for a business, all sorts of parameters within that. And with a few specific exclusions, they will look at your business plan and they will basically say, does this person know what they're doing? Okay. Most other commercial finance providers will treat things rather differently, and they'll look at security. Now, I use the term secured and unsecured. It's a bit of an anomaly. In industry terminology, secured loan means there's a charge against bricks and mortar or solid assets, yeah, which 95% of the time is bricks and mortar. So we'll treat that as a separate entity. If you have a spare property that you're happy to put a charge against, it will be fairly easy to get a secured loan against it.
So for me, in previous years, I've had borrowing of the business's borrowing secured on my family home.
Yes.
Yeah.
Yes. So that is your classic secured loan. Yeah. An unsecured loan, which is where the confusion comes in, will always carry a personal guarantee unless you have blue chip set of accounts. The reason for that is because a lender is simply depositing money into your business, and other than seeing monthly repayments, they have no input to your business, no visibility of your business. So frankly, that money can just disappear tomorrow and nobody will know where it's gone. Yeah. So that's the reason why they will always want to look at personal guarantees. To varying degrees, they'll look at the strength of the guarantee. So if it's a smallish loan or they're fairly confident in your business, it will just be what you might call a behaviour guarantee. If it's if they're less confident in your business, they will look for a little bit of solidity behind the guarantee, normally in terms of property ownership.
And think where we're talking about loans, these are businesses, because it's easy to forget that actually a bank isn't a charity or a bank doesn't exist just to help your business grow. They make money and survive as a business by helping profitable, sustainable, less risky businesses to grow. So as you said there, if they're just going to hand over a wedge of cash, they want some form of protection that they're going to get that cash back. And that's where we're talking about with personal guarantees. Or
Absolutely.
Yeah. I've not heard the term spot funding before, but I've heard the term overdraft because it was our company overdraft that was secured on my house. So from that scenario, is spot funding and overdraft the same sort of thing?
Yes, banks have pulled back on overdrafts quite substantially. This is down to the way they're monitored and regulated, and overdraft is considered to be a high risk lending product from a regulatory point of view. So they're not as keen to put them out now. So a big industry has emerged that people will lend money on short term for days, weeks, possibly months at a time. And I'd refer to it as a dip in, dip out facility. So you set it up, say for example, it's a £20,000 facility, and you dip in as you need it. You possibly pay a recurring charge, but by and large, you just pay for the money you have for the duration of time you have it. And then in 6 months' time, if you need it again, you dip back in. So this is basically the independent market replacing the overdraft, or bridging the gap where overdrafts are disappearing. So it's product-wise, it's quite similar.
I was going to say, it doesn't sound too dissimilar from a credit card in a roundabout way.
No, it probably fulfills a similar function to a credit card, but of course it gives you, whereas a credit card is used for specific payments, you can pay your wages with it, you can pay, so some of your software overheads with it as well.
Now, what this invoice finance is something which on UKBF I've suggested to some small business owners who've gone on there and asked questions about sort of delays in their customers paying them and just trying to keep their cash flow going. Invoice finance has pros and cons against it. Some people are anti it, some people are into it. But what is invoice finance?
In its simplest form, invoice finance is you supply boxes of goods to Sainsbury's or whoever. They want 60 days to pay you. The invoice finance company gives you a big portion of that money on day one. You can extend it to trade finance so that you're actually financing the goods before they're delivered. So it's basically relying on a strong contract with an end business user normally for delivered goods, or
Something
for
tangible.
a very solid fulfillable contract.
And the input where you mentioned the contract here, I think it's important for the viewers to appreciate. You need to have proper terms and conditions and supply agreements in place with the people, your customers, to use this facility. Is that right?
Absolutely, yes. So there has to be a proper contract, and there has to be something deliverable. It can be a service, but it has to be finite.
Right.
So it has to be, if you like, if it's building related, signed off by a QS.
And this relates to, so there is still even some research done by the FSB not too many months ago still shows that large corporate companies dealing with smaller firms are still taking long periods of time to pay the small firms' bills, which is crippling some of the small businesses. So in scenarios like that, but it doesn't have to be big companies, I'm presuming here, if cash flow, so the money you actually have in your bank to pay your own bills and your own pay is running tight, you're delivering whatever it is you're delivering, on paper you look like you're doing really well. You've got great sales figures, but you don't have the money in the bank. This is a sort of product that can help you out.
It's precisely that purpose.
Yeah.
It is trade. It's for the financing of ongoing trade. Credit control is a whole different topic.
Yeah.
Very, very closely related topic.
Yeah.
But as you correctly say, once you've delivered goods, on your balance sheet you have an asset. In real life you have a liability until that money is paid.
Yeah.
And we take invoice financing, factoring, various terminologies around it to an extent. You can insure the debt, you can have full credit control facilities at your disposal.
Yeah.
So you can really extend that to being your full credit control department.
Yeah, because they chase the company that's basically giving you the money in return for your, they maybe not the right terminology, but they kind of like buy the debt off you. So
yes, no.
they take over.
But by and large, you can sell debt, yes. Yeah. But by and large, they advance against a debt.
No, yeah.
To varying degrees, they will then recover, insure, and guarantee that debt. So there's, it's actually a suite of products rather than a product. And as Ian Johnson knows all of the ins and outs, and this, he's probably shouting at your screen now. But
being the resident sort of invoice finance.
Absolutely, yes, and he's the man I would speak to about invoice finance queries, because I understand the principles of it.
Yeah.
He understands the technicalities and the details. But it's a product that has evolved hugely. You're right, there is still some negative stigma hanging around it. I've put that squarely at the doors of the banks for creating that problem. It is a fantastic product, used well for growing a good debtor book.
And when we're talking about other borrowing like loans, there's quite a good understanding in society that you borrow money, you pay you have your interest and you pay that. With invoice finance or factoring, is it correct that effectively if your bill to your customer is £100, that bill effectively through whichever transaction rate goes to the finance company, the invoice finance company, they pay you, let's say, 90 quid. The percentages will vary before Ian shouts at the screen. You get £90 of that. They chase in the £100, and that £10 difference is their profit for providing the service with their fee. Is that
again varyingly? Yeah. So at its most basic level, they'll advance you your £90.
Yeah.
And then when you recover your money, it recycles in reality, but there will just be an interest charge and maybe a rolling fee, but you'll recover the best part of your 100.
Right.
Then at the other extent, you'll have it insured, they'll do the collection, and you'll probably end up with the 90.
But the key part here is this is what some people may refer to as like cash flow finance. This is managing your cash flow because you're trading fine, everything's going fine, but you're waiting for your customers to pay you. And then asset finance, the last one you mentioned, what's asset finance?
Well, in its everyday terms, the one that pretty much everyone knows about is your HP on your car.
Yeah.
That is bog standard asset finance. You put down 10%, you repay the amount over 3 years with or without a balloon at the end of it.
Yeah.
And that's it.
You
offset the value of it against its use.
Yeah.
My world is slightly less simplistic than that because we finance a huge range of asset types, which if I look around this room, pretty much anything in here. It's more complex because the lender doesn't have the security of knowing they could take a car back and stick it through the auctions and get some money for it. We'll finance these curtains and that foam padding, which are absolutely worthless if anything goes wrong.
Yeah.
So, but yeah, the principle of asset finance is it's a fixed term piece of borrowing for pieces of equipment that you are buying. I think that covers it really.
So then really, if we take all those different types of finance that we've just talked through and align those to, I'm going to sort of pick out like 4 points in the life cycle of a business. You've got your pre-startup. So it's your idea, you're thinking about it. It might be proof of concept, but you haven't actually launched a business yet. So pre-start. You then have your early start, your startup stage. You've got your up and running, you've got going, and then you've got your growth, or as some of the like the banks now will call high growth sort of areas. If we was to sort of break out those areas, and sort of align, you know, what types of finance might suit some of those areas best. If we was come from a pre-start, so I'm sat here, I've got this great idea that's going to make me the next Elon Musk, I think. And not quite sure, you know, I haven't quite got enough money to even get a proof of the concept. Now, this could be something like building an app on the mobile, or just getting something working, or building a prototype product. And what would you be sort of suggesting to me as the sort of types of finance that might help me at that stage?
Externally speaking, which basically I'm excluding your own money and your parents' money,
yeah,
and indeed your personal borrowers, to engage investors and angels. And when you're talking that level, it's possibly going to go down that route. As we say, they're going to want a proof of concept. Yeah. They're going to want some market research, and they're going to want a monetized model. Yeah. It doesn't have to be profitable, doesn't even have to be revenue generating, but you have to be very clear on what the revenues will be. So until you get to that point, to be absolutely honest, you have to use your own money, and the best advice is to use as little of it as possible. Yeah. And one of the best ways to use as little as possible is to invest in things like market research and a good coherent business model before you start throwing money at prototyping.
Yeah. So this is more really, if you haven't got anything tangible that shows a viable business, it's hard graft is what I'm picking up from what you're saying. And if you really do need to pay something out, then it's whatever you can personally lay your hands on.
Yes.
Is that what I'm...
Yeah. Yes, and we have to come back to bootstrapping, because the best way to finance a business is by bootstrapping.
Yeah.
Without exception. If you can do it, keep your job, do it in the evenings.
Yeah.
Get a job in the evenings delivering pizzas if you need the daytimes to do it in. Do what it takes to get your business to a stage where other people are interested in it.
And this is where, for those who do watch programs like Dragon's Den that I mentioned earlier, you'll get people going on there very product focused. I've just invented sliced bread. It's going to revolutionize the world. And then the dragons will turn around and say, so what's your year 1, year 2, what have you done last year, what's your revenues? And these people are saying, well, we lost 20,000 that year, and then the year before we lost 30. You've not proven the model. And then they're saying, well, if I was to put money in there, I want 90% of the business. That kind of angle. Yeah.
As you say, it's about the business, not the product.
Yeah. So I've gone through the process. I've worked evenings, I've worked weekends, I've kept my day job, maybe taken an evening job, whatever's necessary to try and get this going. I'm now ready to make that step to give up my job, turn my side hustle into my core business. I've chuckle when I say this, I wrote a business plan. Maybe we'll come back onto that one. But for whatever, I'm at the stage now where I'm fully committed, and my proof of concept, I might even have like a small number of customers paying some money coming in now. But I haven't quite got enough to pay my mortgage, let's say, or I haven't quite got enough to buy the computer or some of the kit I need, or whatever some of these startup costs are going to be. What are my options there, the best options?
Okay, so this comes back to your plan and your purpose.
Yeah.
You've touched on a couple of things there. The more defined the purpose is, to an extent, the easier it is.
Okay.
So you mentioned buying a computer, that immediately draws us down to the asset finance route.
Right.
You've got some new customers, but you're struggling to fulfill the orders. We're going to start thinking about invoice finance. They may not be the absolute answer, but it's a good starting point. And these lenders, because they are particularly focused on a purpose, they're rather more flexible than the other more esoteric types of lenders. I will throw in again the government startup loan.
Yeah.
They will focus very strongly on your plan and your purpose.
Okay.
But if it's just you need £7,000 to pay the wages, pay the rent whilst things turn around, buy in stocks, then that is a great facility.
And just on that one, then, just to think about it, I know we'll send some information out after this, sort of where people like reach out to maybe to talk about this or go onto the forums. But generally speaking, is a startup loan something that the startup loan refer to? You go to, is there like a set of people, or is it a different thing to apply for? Do you just walk into your NatWest or Barclays?
No, no, it's totally distinct and separate from any of the bank facilities. It's run through British Business Bank, but delivered by delivery partners.
Yeah.
I'm an associate of Transmit, one of the delivery partners.
Yeah.
So I'm, if you like, their feet on the ground.
Yeah.
I do a little bit of hand holding and mentoring to help you get your business plan together. And I will stress here, we do not do the business plan for you.
No.
It's your business, it's your plan. But we give it a few little pointers and guidelines and review it and say, think about that, go and do that.
Okay.
Transmit, then process it. And ultimately it's backed by the government through the British Business Bank.
Okay. So that just sort of meant, I thought it worth clarifying that part, because as you say, that's probably quite a good, the sort of your startup early stage, it fits quite nicely with that if you've got the plan together.
It is the ideal product for the purpose.
Yeah. Okay. Now I think we covered this quite well when we were talking about invoice finance for a start. So we're still on that journey. So we've gone through, I've now got my product up and running. I've got a steady flow of customers. The my order book looks great. I'm busy day and night. I'm literally pulling my hair out, like constantly just churning through. Business, everything feels like it's booming, but I've got no money in the bank. Literally, my customers are taking ages to pay. It's robbing Peter to pay Paul kind of scenario. I've reached that point where I'm post startup. I just want to trade. I just want to pay the VAT bill. Those sort of things. So what fits within that area?
Okay, this is of course about financing a business, but the best starting point is not to need finance.
Yeah.
And just picking up a few things you mentioned there, obviously credit control is really important to a business. I'm tempted to go rambling on about it, I won't. Spending effort on getting in money you're owed is more valuable than spending effort on going and generating more leads. And it does tend to get overlooked a little bit. Keep an eye on your processes. Keep an eye on your own credit terms, the credit you're getting from your suppliers. Keep an eye on your costs. That's me going off the whole, business funding thing.
But it's so
because
true.
if you can not need funding, you will have a better business. And I say that as somebody who's earned a living from lending money.
But the thing, the issue that people will have there, particularly if you're excited about your business and you're excited and you're worried about the customers and you're worried about where the next customer is going to come from, it's so easy to become distracted by pushing your product, whatever it is, whether you're a web designer, whether you're selling creams, whether you're selling chairs, whatever it all is. As the business owner, you're focused on shifting your product and not the boring admin parts.
And the most boring piece of admin is chasing debts. But it's critical. So yes, every business owner is in love with their product or their concept.
Yeah.
That's a given. The nitty gritty stuff is getting to grips with what goes around it. And in truth, invoice finance sort of jumps out again. But in invoice finance, will actually want to know what you're doing.
Yeah.
They'll put credit limits on your customers, which you should be doing yourself anyway.
Yeah.
So to an extent, you're replicating what you could potentially do within your own business.
So you're really saying the first priority. So let's say I sell chairs and I'm turning out, making these handmade chairs. I'm shipping them out to cafes. And my invoice term says 14 days or 30 days for payment. And actually what's happening is nobody's paying me until I'm chasing on the phone at 60 days, 70 days, 3 months later, or not paying me at all, that kind of thing. That's not a problem that any finance solution is going to really realistically fix.
It's a sticking plaster, isn't it?
Yeah. So at that point, as the business owner, your advice is you might be working 7 days a week, let's say 5 days a week, you've managed to get your weekends off. Don't work on building your products on your Friday. Spend your Friday going through your accounts process and making sure people are paying you on time.
Outsource it maybe.
Yeah, bringing in.
As I say, it tends to get shoved to the bottom of the pile.
Yeah,
and it is a shame because that's money you worked very hard for that's sitting in somebody else's bank.
Yeah. But if you've got your systems working, but actually your contract terms, now we have contracts as a company with some large corporate customers, and they won't sign the contract at 30 days. It will be 45 or it will be 60 days. So we either choose to work with them or we don't. Now, if the industry you're in is just happens to be 60 days, and you either choose to, when you have to make choice to work with them if you're in that situation, but for you personally in your own cash flow, you need that money sooner, but you also need that contract, and it's a signed contract, picking up on your earlier comments, and it's all watertight. That's where you're saying invoice finance is a good, viable solution.
Invoice finance is the logical answer to that problem. Not 100% accurate, but if your problem is collecting in trade debt or debtor days, then invoice finance is the natural, logical answer.
Okay.
If we come back to it, if you're just finding that for 2 days at the end of the month, things are a bit tight, you probably don't want to take on a big loan.
No.
You'd probably work for some kind of spot facility.
Okay.
Whether it's, if your bank will give you an overdraft, that's brilliant. One thing I would say, we always talk about banks. Banks aren't the most fluid or flexible organizations in the world. At this moment, they're not fantastically good at financing startups and micro businesses.
No.
There are a lot of alternatives out there. So yes, talk to your bank, but don't assume that the answer the bank gives you defines the market.
No.
There is a huge independent non-bank finance market offering all sorts of products. So yes, if the bank says no to an overdraft, there's still a good chance that you can get some sort of short-term funding facility, which would be ideal if you only need money for a number of days per month, per year.
No, fantastic. Things going well. I'm not struggling financially. I'm managing to pay the bills in the business really well. I've got a flow of orders, and I reckon if I could just upscale, bring in more team, bring in a bit more machinery, move to bigger offices, sort of take the business next level. I've got I've got a waiting list of customers as long as my arm.
Yeah.
It's like that, but I don't have the cash in the bank to fund the growth and upscaling of the business that I want to do. What options are open to me at that point?
Okay, there's conventionally, you've mentioned equipment, that brings us into asset finance, of course. Conventionally, if you just need money to grow a business, again, you plan any purpose. What do you need it for? What's the return going to be? To simplify it, if you're growing a business with fairly good recurrent revenues, you're doing more of the same, the money's going to come in a reasonable period of time, then that's where your business loan is probably going to be a good friend for you. You go out, you get £100,000 or whatever, you pay it back over 5 years.
Yeah.
And it is the ideal tool for that kind of level growth. If you're taking a big lunge and your returns are going to be delayed, you probably want to start thinking maybe in terms of investors and angels.
Yeah.
They really come into their own when, say, you're doing something and the returns won't happen for a year, for 2 years. Well, you're going a long way backwards to go even further forwards, I suppose.
Yeah.
And that's really where they come into their own, because your return on their investment will be way in excess of what you're giving to them.
And this is a key point really here when you're mentioned earlier that they are generally successful business people who have been through this journey. And two things really. I'm actually remembering some threads from the forums themselves where people post up looking for finance, looking for another founder to join me, sort of stuff. And they're not really at this stage of going to the next level. The people who are making these posts, and during the conversation we're having here, this is the first point where angel investors have come up as the key point, and it's where, in using me as an analogy, I've gone through, I've done the proof of concept, I've done that myself. I've got the business up and growing, working from my spare bedroom, let's say, or my garage or whatever it might be, getting and proving that it's actually working. I've gone through those pains. I've now got a consistent business that's proving it can work. And now we're looking to bring in some potential people to buy some shares in the business as investors, because I can then prove a more sustainable business model, business plan, and also have the previous trading history to back up the projections that I'll be putting in my forward forecasts to pitch to the dragons. That's sort of a fair.
Yes.
Yeah.
Yes. Yeah. So I mean, your time is perfect, isn't it? They talk about sharing the pain, feeling the pain.
Yeah.
You've felt the pain.
Yeah.
You've got something to a stage where it is a business.
Yeah.
It's not an idea or a concept.
Yeah.
It's got proof of concept. It's got proof of revenue. It's got proof of everything in place. To be fair, you're probably further advanced than a lot of people would be when they go the angel route.
Yeah.
But yeah, you need to be at the point where you know whether it's going as a business.
Yeah. And somebody who's going to invest into the business, they need to, their decision, they're going to be putting a risk to it in their heads, or whether it's on paper or in their heads, they're going to be risk assessing. How risky is this investment going to be? Because if there's a high risk, I'm not going to get my money back, they're more likely to walk away and go not interested, or going to say, I want a bigger share of that business, so that if I don't like the way this is going, I'm taking it. You've got to be prepared for that, I'd say, as an entrepreneur bringing investors in, that if you're going right at the early stage and you've got nothing to back it up, no hard evidence to back up your claims, then be prepared to just give the business away if it doesn't work and invest. I'm not saying they would, but
the cliche is they don't invest in ideas, they invest in people.
Yeah.
So your investors look at you.
Yeah.
It's not okay. You've got the evidence, which is great,
yeah.
But they're still looking at you and say, is this the right guy to take that to the right level?
Yeah. Well, for me, I personally, when I actually did go through this scenario, it was 2015. And there was a lot of courting, a lot of meetings going through. I had reams and reams of paperwork and spreadsheets and graphs and the plan. The irony is, as soon as we set on the angels invested into the business as it is now, well, it was nothing like it is now. Back then, the business plan that I put together and thought I'd put so much effort into wasn't ripped up, but it was literally like, okay, let's change all of this, which in hindsight reaffirms what you've just said. they did a large proportion was their faith in me,
Yeah.
which I say if they're watching here now, I'm very grateful for. But again, they're also very successful business people who have gone through, and they own a big chunk of the business. It's our business. I think reflecting on those where we've got to now, I've picked up a common theme of, as you've been talking through, about sort of preparing for this, but for the avoidance of doubt, because I feel it's a very important thing to get across. What is the biggest piece of advice you'd give to somebody at any stage where they're looking to try and raise some money in one shape or another for their business?
Well, there's the recurring theme, a plan and a purpose.
Yeah.
Understand what you need, why you need it, how much, when you need it.
Yeah.
Because if you're not clear on those things, you won't be able to choose the right sort of borrowing. And also the lender won't have much confidence in what they're lending you. And the plan might or might not define the purpose. And the other thing is commitment. You need to be committed to what you're doing. That means providing the information, the time that your lender, in the broadest sense of the word, means. Now, if you're getting hire purchase on a car, that probably just means giving them a set of accounts and some bank statements, maybe not even that. If you're going for equity investment, as you know, it's a job. You need to put your heart and soul into it. You don't just bang out a few messages saying, will someone give me some money? No, you commit to it. In fact, the Fever Tree people went on record as saying that they regretted getting equity finance, not because of the dilution, but because they felt the time and effort put into getting that finance would have been better spent developing their business. And that's, I'm not saying they're wrong or right, but I'm saying that is the sort of commitment you need to get high level equity finance. So even with a startup loan, you have to commit to doing your business plan and to doing things the way they want to see it, because it's their money.
And the plan, because I'm a big advocate of having a clear plan. And it doesn't have to be something that you stick to for the next 10 years. You have to be variable to adapt to market conditions and so on. But you actually need to have a plan of what you're doing. The putting that plan together and then putting some financial assumptions against that, I feel, would highlight points where you may need additional funding. Or where your cash flow may go slow, because a good plan would have, and I mean, I'll hand it over to you to explain. So, in my plan, you have your profit and loss forecasts, you have your cash flow forecasts. I did a little video a little while ago that all the money in the bank's not yours. And I think that's quite a good one. If I hand to you and say, what's the difference between a profit and loss forecast and a cash flow forecast?
Personally, I always put a huge amount of emphasis on the cash flow forecast. A cash flow forecast is real money. It's what you have and what you can do with it. Profit and loss, of course, is emphasized and loaded, isn't it? So just for an example, to pick up on something we've said, you've sold your goods to a supermarket. You can count that money as profit. And you can run off away, celebrate, patting yourself on the back and celebrate. Until they've paid you, it's not cash. And
so
that's probably the single biggest example.
If we use that just to emphasize it, so if you sold that product for £5,000 in April, in your profit and loss, you see a £5,000, let's say, profit in April. But in your bank, that £5,000 ain't there. And it might not be there till June or even July. But you still got to run your business for those few months.
Exactly. So no matter how profitable your business is, if it doesn't have cash, it can't continue. And this is why cash flow really does trump profit. I'm not saying profit isn't important, of course it is. But your cash flow is your day-to-day, your breathing of your business. And if you haven't got on top of that, then unfortunately you don't have a business.
And I think that's sort of a really important piece that would sort of wrap up with at the point now. The is because I've just clocked the time in front of me there. That it's been a really good conversation. That's we've sort of spoken for an hour, which it doesn't feel like it,
Good,
and
yeah.
it's a really sort of broad topic as well. With each of these sections, there's so many sort of like permutations of variables, which emphasizes the importance of having the right advisor or supporting you at these stages, whether that is your accountant or whether that is a specialist in finance, like as you say, plug yourself here, that this the area that you specialize in. What I'll say for here is like a massive thank you for
No, thank you.
giving up your time here to come and speak to those within the audience. For those who want to sort of re-watch this webinar, it's going to be available on our YouTube channel in the next few days. You'll receive an email notice following this sent out to all of you with information, both from Mark himself about how to reach out to Mark, ask any follow-up questions. I'd also ask, there'll be a very short questionnaire that will come out to you. This is the first webinar that we've done, and I would really appreciate your input and feedback on what you feel that went well and other areas of interest or questions or topics you'd like us to cover in upcoming webinars. Thank you very much for watching, and look forward to seeing you on the next one.
Thank you.